Hello and welcome back to the chapter on reporting and analyzing liabilities. We are now on to the third learning objective, which is the actual bond transactions. The company is issuing bonds, paying interest, and will repay the bonds. So to start with, when the company issues bonds, they know what the interest rate is that they are going to pay. That's called the bond contractual interest rate. It's also called the stated interest rate or the bond interest rate. At that exact time when they are issuing bonds, the market interest rate may or may not be the same as the bond interest rate. Now, if it so happens that the bond rate and the market rate are exactly the same, the bonds will sell at face value, which means the exact amount that I ask for, the investors will give me that money. However, if the market interest rate is lower or the market interest rate is higher, then the bonds are not going to issue at face value. So what happens? If I'm offering 10% and the market is offering only 8%, there's going to be a demand for my bonds. So I'll be able to get some extra money when I issue the bonds. I'll be able to sell it at a higher price. If the bonds are paying 10% and on the date of issue, if the investor chooses to go and buy a similar investment somewhere else and they can get 12%, why would they come to me? They're not going to come to me unless I offer a discount. So what that means is they will pay me less than what I'm asking for right now. Now keep in mind, interest is always paid on face value, regardless of how much I got at this point of time when I issue the bonds. And the principal, the face value, is the exact amount I need to return at the end of the life of the bonds. So that the selling price is not going to affect interest payments or the repayment of the bonds. So here's a quick example, the presentation. I have bonds payable of 100,000. I sold it at a discount of 98,000, which means I said I take $2,000 less right now. Okay, once again, if you recall, the reason I got less is because the market is offering more, and therefore I said I'm willing to take 2,000 less. I will pay interest on 100,000 and I will return 100,000, but the bond holders, the investors, are giving me only 98. What is a gain for them is a loss for me. This discount on note on bonds payable is a loss, and it's a contra liability account that's going to be kept in my books, and I will amortize it over the life of the bonds. That process of amortization is basically writing off that loss, spreading the loss over the life of the bonds. So the issuing company must pay the contractual interest rate over the term of the bonds, and they will return at maturity the face value, not how much they got. So they'll return the 100,000. The interest is paid on the 100,000, but right now they're getting only 98. So the 2,000 is a contra liability account. What happens if the opposite is the situation? I'll come back to that. If the opposite is the situation, I ask for 100,000, but my interest rate is much higher than the market rate. So people want to invest with me. They want to buy my bonds, and I was able to sell it at a premium, which means I got $102,000. How much will I return to the bondholders? 100,000. I don't have to return the 2,000, only the 100,000. On what amount will I pay interest on the 100,000? Now, let's see what the cost of borrowing is, the total cost of borrowing. The interest is 50,000 over 5 years, in this example, 10% per year. And the loss of 2,000, the upfront loss, the total cost is 52,000 over the life of the bond. Now, what would it be if it's a premium? That interest stays the same, 50,000. But I got 2,000 more when I issued the bonds. Therefore, the cost of borrowing drops to 48,000. So we're playing a numbers game over here. Now, the amortization, a company may use the straight line method or the effective interest rate method. The US GAAP says we should use the effective interest rate method, but if the straight line method, the amounts are very close, then we can use the straight line method. For the purposes of our textbook, we use the straight line method. If it's a bond discount, the amortization, it's allocated as an expense. Remember that loss needs to come into the income statement, and it needs to lower my net income number. So it's going to be allocated to expenses. It increases the bond interest expense each reporting period. The amount of bond interest reported each period will exceed the amount of cash paid. We'll see how to do that in a journal entry. As a discount is amortized, the balance declines. Remember, amortization means writing off. So each time I do the amortization, that discount that I have, the $2,000, keeps declining. It keeps dropping off. And the carrying value of the bond will keep increasing. So I'm going to stop this PowerPoint slide here and work on a quick exercise. And we'll first just work with bonds issued at par, where we don't have to worry about discount or premium. Those will be in the next two videos. So let's take this example that I have set up over here. The date of issue is Jan 1st, 2020. We are borrowing $100,000. The term is 5, which means 5 years. I'm borrowing the money today. I will return the money 5 years from now. The bond interest rate is 10%, and on this day, the market interest rate is also 10%. Therefore, my bonds issue at face value. It's always stated as a percentage of this principal amount. So my journal entry over here is very straightforward. I asked for 100,000 and I got 100,000. So cash debit, bonds payable credit, and that amount is exactly 100,000. I got the exact amount that I wanted. Now let's assume that interest is paid annually on January 1st. So at December 31st, I need to do a journal entry, and that journal entry is an accrual entry. It's going to be bond interest expense debit and bond interest payable credit, $100,000, 10% for 1 year. The amount is going to be $10,000. $100,000 times 10%. I'm looking at the bond interest rate. This is the number I'm looking at, not the market interest rate. In this case, they both are the same interest rate. Okay. Now, when do I pay this money? As I said earlier, I'm going to repay this money the very next day. Okay, so the money that has to be paid that I've accrued over here, I'll pay it up the next day. So my journal entry is going to be bond interest payable debit and cash credit for $10,000. So I have to do the accrual entry because December 31st, I have to finalize my financial statements. The interest has accrued for the full year. That $10,000 has to be accrued. But the very next day, that liability disappears from my books because I pay up that money. Now, these two journal entries that you see over here will be repeated for 5 years. The same journal entry keeps getting repeated. Okay. Now, let's say I keep my bonds all the way to maturity. So it's 5-year term. I issued it on January 1st, 2020. So on January 1st, 2025, after I have made the 5th interest payment, so I paid this $10,000 for the 5th time, I now am ready to redeem or retire the bonds. At this point of time, I'm going to pay off the bonds payable debit, cash credit, and that's $100,000. So this is a very simple, straightforward exercise we have looked at. Now let's quickly look at 2 more situations. What happens if the bonds were paid off early? Okay, so instead of waiting for 5 full years, I paid it off on Jan 1st, 2023. Remember, always when you're returning a liability, you have to first accrue and pay interest up to that point of time. So that journal entry has been done. So how many years have we had the bonds? 2020, 21, 22. 3 full years we had the bonds. We are now returning this money. But the redemption is at 101. I have to pay an extra 1% of face value in order for the bondholders to agree to this early redemption of bonds. So these are those callable bonds. Okay, so here we have bonds payable debit. That part is easy. I know exactly what the amount is, 100,000. I now know how much cash I'm going to pay. I'm paying 101, 1.01%, the 101%, which is 1.01 times 100,000. So I'm paying an extra $1,000. This extra $1,000 I'm paying, now that the bonds are getting wiped off from my books, I need to recognize this as a loss on redemption of bonds payable. So it's a loss that goes into the income statement right now. As I said in the previous video, a company may decide to pay these bonds off earlier because perhaps instead of 10%, they can issue new bonds at a much lower interest rate. Or they have the 100,000, why in the world would they continue to pay 10% interest if they can repo those bonds? Okay. The exact same exercise, now let's change one thing. Instead of 101, they are paying 99. You could ask, how could someone agree to receive 99%? Well, probably they're not agreeing to receive 99%, but maybe they're trading in the open market at 99, and I have sufficient cash and I can go and buy those bonds and call it a day with these bonds. What happens over here? Let's see. Once again, bonds payable will be debited and cash will be credited. Bonds payable is 100,000. Nothing's going to change that. That's the face value of the bonds. Now I'm saying I'm paying 99% of 100,000. I'm paying only 99,000. This $1,000 that I saved, that I didn't have to pay, I will recognize as a gain on redemption of bonds. This is the gain on redemption of bonds. So on the early redemption of bonds, I saved $1,000. So this example, once again, we looked at bonds issued at face value. The next video, we're going to look at bonds issued at a discount and bonds issued at a premium, and we'll see how that differs from bonds issued at par.